U.S. labor data revealed only 73,000 new payrolls added in July, well below consensus estimates, and sparking investor concern over weakening employment conditions. May and June data were revised lower by nearly 258,000 jobs combined, deepening the shock. These revisions increase the likelihood that Federal Reserve policymakers may pivot more quickly toward rate cuts than previously anticipated. Market volatility surged as risk assets responded to deteriorating fundamentals. Traders now face uncertainty over growth trajectory and monetary stimulus timing. President Trump's executive order imposed sweeping tariff hikes ranging from 10% to 41% on imports from over 66 nations, including India, Canada, Taiwan, Switzerland, and Brazil. Despite initial expectations that protectionist threats might be softened, markets reacted sharply to firmer trade policy execution. Analogies to previous take-o-trade complacency quickly faded as equities and crypto reversed gains. Analysts raised average U.S. tariff burden from roughly 2.5% to over 15% almost overnight. Business leaders flagged imminent planning disruptions across manufacturing and supply chains globally. Global equity markets tumbled in response. The Dow Jones fell approximately 1.2%, the S&P 500 dropped 1.6%, and the Nasdaq declined roughly 2.2%, marking one of the worst sessions since May. Technology stocks led losses as investor sentiment shifted toward caution over growth and trade headwinds. Regional indices mirrored global risk-off flows, with developing markets experiencing sharper drawdowns. Inter-sector correlation spiked, reducing portfolio diversification benefits. Analysts emphasized that risk appetite deteriorated in response to converging macro shocks. Cryptocurrency markets faced intense pressure as total value declined by 7.3%, with Bitcoin falling to just above $115,000, underperforming broader risk assets. Ethereum dropped nearly 6% to around $3,620, while Solana and Dogecoin shed more than 6 to 7%. XRP declined about 7.5%, demonstrating widespread investor retrenchment. Larger capital pools exited leveraged positions, leading to liquidation cascades. Crypto sentiment indexes reflected elevated fear and widespread caution among traders.
Liquidations accelerated sharply. Over $754 million in total crypto positions were liquidated in one day, including $707 million in long positions, highlighting the depth of forced deleveraging across major digital assets. Over 200,000 traders were adversely affected in this sudden price drop. The event underscores vulnerabilities tied to margin and leverage in crypto directional strategies. Funding rates surged and open interest spiked into the $809 billion range. Traders are now recalibrating risk exposure and monitoring liquidation thresholds closely. Spot-based Bitcoin ETF flows reversed sharply, with $115 million in net outflows recorded in a single day, erasing momentum from earlier weekly inflows. Fidelity and ARK were among major issuers, seeing redemptions of over $300 million each, reflecting institutional profit-taking amid risk-off sentiment. Ethereum ETFs saw early week inflows of $218 million, but momentum faded late as net additions dwindled to just $17 million. The reversal suggests cautious reassessment of crypto exposure by institutional capital. Analysts see weak ETF dynamics reinforcing short-term bearish pressure. U.S. Treasury yields fell notably as uncertainty spiked. The two-year Treasury yield dropped 25 basis points, reaching multi-quarter lows near 4.2%, signaling bond market concern about growth and recession risk. Simultaneously, Treasury demand strengthened as investors rotated towards safe assets. The U.S. dollar reversed earlier gains, declining nearly 1% and halting prior appreciations. Bond and currency dynamics now point toward reduced equity appetite and elevated macro anxiety. These signals support the case for future Fed rate cuts. Equities performance by sector revealed that consumer discretionary, healthcare, and materials stocks weighed heavily on indices, each falling between 3 and 5% over the session. Only utilities and energy sectors showed slight resilience, with gains between 0.2 and 1.5%. Information technology reversed earlier momentum as earnings concerns resurfaced. Internally, analysts highlighted that defensive allocations outperformed growth-exposed themes. Market volatility measures rose across VIX and sector-specific analytics.
Commodities responded unevenly. Gold prices surged approximately 1.5%, approaching record highs near $3,400 per ounce, reflecting safe haven flows. In tandem, oil futures rose moderately amid inflation risk, while copper prices declined sharply on trade-related industrial concerns. Silver and agriculture ETFs remained flat or slightly negative. Overall, commodity markets appear bifurcated on risk signals. Gold up, base metals down. Hedge strategies increasingly rely on cross-asset coordination. Treasury auction pressure remained manageable despite volatility, with new issuance absorbed by strong institutional demand. Bond trading remained orderly, credit spreads were contained, and liquidity flows favored quality fixed income instruments. Margin debt conditions remain elevated, but trading platforms showed no systemic disruption. Institutional risk appetite retreated modestly into government paper and high-grade corporate bonds. Analysts view credit markets as stabilizing forces amid equity volatility. On-chain whale flows revealed significant movement. Large transfers of Bitcoin from custodial wallets suggested strategic rebalancing amid price declines. Meanwhile, Ethereum large wallet activity accelerated as institutions paused accumulation and prepared for volatility. On-chain exchange inflows indicated some sell-side pressure, but stabilization as price approached technical support zones. This aligns with ETF outflow patterns and margin deleveraging. Market analysts see structural holders continuing to anchor price floors. Dogecoin witnessed notable institutional interest, with a single whale depositing over 130 million Dogecoin into exchange accounts, likely positioning for potential rebounds or strategic trades. This comes even as Doge price retraced amid broader altcoin sell-off zones. The dichotomy between accumulation flows and market price pressure underscores investor segmentation. Technical analysis shows Doge approaching key support near 20 cents to 22 cents region. Analysts suggest selective capital continues targeting legacy meme assets despite risk-off backdrop.
Smaller altcoins like Shiba Inu and Bonk declined sharply by 5 to 12%, highlighting liquidity constraints and high volatility among speculative tokens. Profit-taking accelerated at resistance bands while momentum evaporated rapidly amid risk aversion. Institutional participation in these tokens remains minimal, and sentiment indicators skew bearish across community platforms. Trading volumes contracted relative to peak periods, signaling retail exhaustion. Energy shifted toward high liquidity assets and ETF-compatible tokens. U.S. technology earnings momentum faded as policy uncertainty overshadowed revenue beats. Apple reported strong services revenue but warned of tariff-related headwinds ahead. Amazon and Microsoft posted mixed growth metrics, contributing to investor caution. Combined with macro signals, tech sector sentiment turned fragile. Analysts downgraded valuations on forward guidance uncertainty. Long-short hedge funds reduced gross exposure until clarity returns. Emerging markets reacted unevenly. Asian equities underperformed amid trade risk concerns driven by high tariffs on India and Taiwan. Meanwhile, European equities outperformed modestly under stabilizing regulatory signals. Currency fluctuations mirrored trade shocks, with yen and rupee weakening subtly. Capital flows favored defensive regions and commodity-linked economies. Investors considered emerging markets exposure selectively based on sector resilience. Venture capital and institutional funding in crypto infrastructure slowed noticeably amid macro uncertainty. Projects focused on stable coins, custody, and regulatory-aligned infrastructure gained preference. Early-stage speculative ventures saw less interest, while compliance platform investments continue drawing attention. Capital markets paused expansions pending policy clarity. Long-term investors prioritize platforms with bank partnerships and token clearance models. The funding environment now favors value over narrative.
NFT and tokenized asset sectors stabilized. CryptoPunk's floor price modestly rebounded above $200,000, reflecting collector confidence despite turbulence. NFT lending platforms reported normalized utilization rather than speculative spikes. Digital real estate listings denominated in Bitcoin and Ethereum remained selectively active among high net worth buyers. Asset tokenization platforms saw increased use for settlement rather than speculation. Analysts view this trend as maturation of digital asset classes. Forward-looking indicators suggest crypto-implied volatility remains elevated but contained, enabling structured option strategies over directional bets. Open interest in BTC and ETH futures stayed robust, even with spot price declines. Options positioning skewed toward protection strategies, with collar and straddle setups dominating over aggressive directional exposure. Sentiment tilts toward tactical hedging and premium capture. Investors expect opportunistic re-entry only once volatility recedes. Market sentiment shifted toward risk-off positioning, with fear and greed index falling into the lower tiers of neutral range. Equity futures traded off early losses before partial recoveries, while volatility surfaces reassessed premium pricing expectations. Cross-asset signals from bonds, gold, and crypto synchronized in bearish alignment. Structural investors appear hedged, while retail liquidity is aligning with safe haven themes. This segmentation reflects strategic rotation amid uncertainty. In summary, today's market stress stems from a trifecta of weak job creation, aggressive tariff implementation, and leveraged crypto unwind. The convergence of these forces disrupted both equity and digital asset dynamics, triggering institutional repositioning and tactical hedging. Bitcoin and Ethereum support zones held moderately well, but broader alpha dipped sharply. Investors now expect potential Fed rate cuts later this year, contingent on inflation moderation. Strategic allocation within regulated channels remains the strongest path forward.